Trying to wrap your head around the crypto world, it can sometimes feel like you're just drowning in data.
Yeah, it really is like a fire hose sometimes.
Right. There's just so much information flying around. Charts, prices, news, opinions. How do you even know where to start, let alone figure out what's actually important?
Well, that's exactly why we're diving into on-chain fundamental analysis today. It's like getting a peek behind the curtain. Instead of just watching the market go up and down, you get to see what's happening at the core level of these blockchains.
Exactly. We're talking about looking at the real activity, the transactions, how people are actually using these cryptocurrencies.
It's a way to gauge the true health of a crypto asset beyond the hype and speculation.
And we've got a ton of great resources to help us unpack all of this. We've got reports from Galaxy and ARK Invest, a really interesting discussion thread over on Reddit, some academic papers, and even insights from the companies that actually provide all this on-chain data, Glassnode, CryptoQuant, Nansen. It's a great mix.
Yeah, a real deep dive. And the goal today is to take all of this information, all these different perspectives, and distill it down to the essentials. We want to give you the tools to understand what these on-chain metrics actually mean and how you can use them to make more informed decisions about Bitcoin, Ethereum, you name it.
So should we jump right in? One of the things that really jumped out at me from the Galaxy report is that, it's not enough to just look at the numbers.
Oh, absolutely.
You've really got to understand how these on-chain metrics are calculated in the first place. It's like before you can read a book, you need to learn the alphabet, right?
Exactly. The Galaxy report makes a great point about how even a simple word like transaction can mean different things depending on which blockchain you're talking about.
Right, because the technology behind them can be very different. So what looks like a lot of activity on one blockchain might not be that significant on another. It's all relative.
It is. And you have to give credit to these data providers like Glassnode and CryptoQuant. They're doing a massive amount of work to standardize all this data. It's like taking all these different dialects and translating them into a universal language of blockchain activity.
Yeah, like building a Rosetta Stone for the crypto world.
Exactly. And once you have that common language, then you can start to identify those fundamental metrics, those building blocks of on-chain analysis. The Galaxy report talks about these primary metrics. Things like the daily issuance of new coins, the annual inflation rate, the total value of all the coins being transferred.
But even with those seemingly simple metrics, there's nuance, right? Like the Galaxy report mentions supply last active, understanding how a data provider defines that, what they consider to be active, that can make a huge difference in how you interpret that number. Like, are we counting internal transfers within an exchange? What about movements between wallets controlled by the same person or entity?
Oh, for sure. Those details matter.
Because different methodologies can lead to vastly different conclusions about how long people are actually holding these coins, whether they're actively trading or just sitting on them.
It's a good segue into talking about how Bitcoin and Ethereum differ in how they create new coins, how they manage inflation. And the Galaxy report does a nice job laying this out.
Yeah, I mean, Bitcoin, with its famous halving events where the reward for miners gets cut in half every 4 years, that's really baked into its DNA. We're currently at 6.25 Bitcoin per block. And this predictable scarcity, it's a big part of the Bitcoin story.
And what's really neat about Bitcoin is that anyone can verify this entire issuance schedule using on-chain data. You don't have to trust someone's word for it. You can literally watch the blockchain and see those halvings happen exactly as programmed.
And the ARK Invest report also picks up on this, right? They emphasize how Bitcoin's monetary policy is transparent and auditable, in contrast to traditional currencies where you just kind of have to trust the central banks.
Right, it's a totally different paradigm. Now, Ethereum, on the other hand, it takes a more dynamic approach. And as the Galaxy report points out, a major shift happened with the EIP 1559 upgrade. Thinking about our present-day timeline, that probably rolled out around August 2024.
Yeah, big change. And that introduced this mechanism where a portion of the fees you pay for transactions, the base fee, it's actually burned. It's destroyed. Poof. Gone from the supply forever.
And this really throws a wrench into the traditional way of calculating inflation. If you just take the number of new Ethereum created and divide it by the circulating supply, like you might do with a Bitcoin, you're not getting the full picture, because you're not accounting for those coins that are being permanently removed.
Right. You need to factor in that burn rate. And when you do, the Galaxy report highlights this. Ethereum's true inflation rate looks quite different. It might have appeared to be around 5% before, but after accounting for the burn, it drops down to something closer to 2%.
And this is where the Galaxy report's emphasis on an asset-specific view becomes so important. Because those big data providers, They might have their standardized ways of calculating inflation, but those methods might not always capture the unique quirks of every single blockchain.
Right. It's like trying to measure the fuel efficiency of a gas car and an electric car using the same metric. It just doesn't quite work. You need a tailored approach.
So speaking of getting specific, let's talk about how on-chain data can reveal the actual economic activity happening on these networks. The Galaxy report talks about tracking things like the number of transactions and the total value being transferred. So like looking at the pulse of the network, seeing how much it's actually being used.
Right. But as you can imagine, it's not always easy to separate the signal from the noise. Not all transactions are created equal. Some might just be internal movements or automated processes. Exactly. And that's why, as the Galaxy report mentions, data providers have come up with all sorts of ways to filter out what they consider to be less meaningful transactions. Like, Glassnode has metrics that adjust for things like change outputs. When you send Bitcoin to someone, you often get some back as change. And they also try to group together addresses that probably belong to the same user.
Right, clustering them. And Coin Metrics, they also offer adjusted versions of their transfer volume metric to try to isolate those transactions that really represent economic activity. It's all about refining the signal.
Absolutely. And then you've got some really interesting niche types of transactions, like the Galaxy report brings up Bitcoin's OP return transactions. They allow people to embed little bits of data directly onto the Bitcoin blockchain.
Yeah, not huge files, but still, it's pretty cool. And you'd be surprised how many creative uses people have found for them.
Right. Like the report talks about timestamping documents using services like Open Timestamps and Origin Stamp. It's basically a way to create an unalterable record of when a document existed. They've also been used to store data for things like the Omni network, which was used to issue Tether back in the day. It really shows you the flexibility, even within Bitcoin's relatively simple design.
It does. And it's a reminder that even though Bitcoin isn't really known for its smart contracts, it still has these built-in features that contribute to on-chain activity and can tell us different things about how people are using the network. Like, the report even mentions that spike in OP return transactions back in late 2018, all because of the Veriblock project, using them for their proof-of-proof system.
So let's shift gears a bit and talk about looking at the supply of these cryptocurrencies. The Galaxy report emphasizes how looking beyond just the total number of coins can be really insightful, especially when you're trying to understand how long-term holders are behaving compared to more active traders.
Absolutely. And one key concept here is what Coin Metrics calls free float supply. As the Galaxy report explains, it's all about estimating how much of the total supply is actually liquid, how much is actually available for trading, by filtering out coins that are probably lost or haven't moved in ages. And they estimate that for the top 5 cryptocurrencies, not including BNB, anywhere from 2% to a whopping 60% of the total supply might be essentially locked up.
Wow, that's a huge range. It really shows you how that headline number, the total supply, might not tell the whole story. It's like knowing how many houses are in a city, but not knowing how many are actually on the market.
Exactly. And it's not just Coin Metrics doing this type of analysis. The report mentions Glassnode and their liquid supply metric. But it's worth pointing out that they don't always agree on the numbers. Like, Glassnode's estimate of Bitcoin's liquid supply tends to be much lower than Coin Metrics' free float supply.
And the report explains that this difference comes down to their different approaches. Coinmetrics focuses more on the raw transaction history, whereas Glassnode builds in some assumptions about the type of entity that holds the coins. Like, coins held by known long-term investors might be treated differently than coins sitting on an exchange. It's a great illustration of how different interpretations of on-chain data can lead to different conclusions, even when they're looking at the same basic information.
Now, let's get a little bit more complex and talk about some of the valuation models that have been built on top of these fundamental metrics. The Galaxy report dives into things like Bitcoin days destroyed and the NVT ratio.
Yeah, and this concept of Bitcoin days destroyed, this idea that you give more weight to coins that haven't moved in a long time when they finally do transact, that's been really influential. The report mentions liveliness, which is basically a way to measure whether long-term holders are starting to sell more actively or if the network is in a phase of accumulation. It's a pretty ingenious way to try to gauge the sentiment of those long-term holders.
And this idea of weighting coins based on how long they've been held, that's really at the heart of coin time economics, which is outlined in that joint report from ARK Invest and Glassnode. They argue that this framework provides a much more accurate picture of the real economic activity on a network because it reduces the influence of those dormant coins.
So what exactly is coin time economics? It sounds a bit like, theoretical physics or something. Can you break it down?
Sure. Think of it this way. Instead of just counting the number of coins that move, coin time economics looks at how long those coins were sitting still before they moved. And they introduced this concept of coin blocks. As the report explains, a coin block is basically one unit of a cryptocurrency that's been held for one block. For Bitcoin, that's roughly 10 minutes. So if you have one Bitcoin that hasn't moved for a whole day, it would accumulate 144 coin blocks.
Okay, I'm starting to see how this works. It's not just about the amount of coins changing hands, but also how old those coins are, how long they've been held.
Exactly. And they define all these key terms like coin is simply a unit of cryptocurrency, unspent refers to coins that haven't been moved, spent are the coins that have been transacted, and lifespan is how long the coin has been held. And coin time itself is the total accumulation of these coin blocks. They even use this analogy like individual gold coins accumulating age to help visualize it.
That's helpful. And the ARK Invest report mentions that one big advantage of coin time economics is that it's more efficient computationally. You don't have to analyze every single unspent transaction output individually because these coin blocks are treated as fungible units.
Right. It's more elegant from a computational perspective. And from this framework, they derive some key metrics like liveliness and vaultedness.
So what do those tell us?
Well, as the report explains, liveliness is the ratio of coin blocks that have been destroyed, meaning spent, to the total number of coin blocks that have ever been created. So a high liveliness score suggests that older coins are on the move.
And I'm guessing vaultedness is the opposite.
You got it. It represents the proportion of coin blocks that are essentially being stored, sitting idle. So by looking at both liveliness and vaultedness, you get a more complete picture of the balance between activity and dormancy on the blockchain.
And the report makes the point that tracking these metrics over time can reveal interesting trends. Like, they point out that Bitcoin had very high vaultedness in its early days, which probably reflects Satoshi's holdings and other early adopters who might not have been actively trading, or maybe even lost access to their coins. As Bitcoin became more widely adopted, liveliness started to increase.
Right, and that makes sense. It's like watching the network mature. And the report also goes into active supply and vaulted supply within this coin time framework.
Yeah, I was curious about those. How do they relate to market cycles?
Well, active supply tends to increase when there's a lot of market activity, like during bull markets, as long-term holders might start taking profits, or even during sharp drops when people panic sell. Vaulted supply, on the other hand, typically grows during those periods of accumulation, like bear markets, or the early stages of a bull run, when long-term investors are hodling strong.
So you can actually see these shifts in sentiment reflected in the on-chain data.
Exactly. And then there's the coin time adjusted inflation rate, which takes into account how long coins have been held when calculating the impact of new issuance. It can give you a different perspective compared to just looking at the raw inflation rate.
Right, because it factors in the age of the existing coins, not just the new ones coming in. So we've covered a lot of ground with these metrics. What about some of the other advanced tools and metrics mentioned in our sources?
Well, the Galaxy report touches on a bunch of other sophisticated indicators, like MVRV, which compares the market cap to the price at which all coins last moved, SOPR, which looks at the profitability of on-chain transactions, and difficulty ribbons, which can tell you about the health of the Bitcoin mining ecosystem.
Right, like whether miners are capitulating or feeling bullish.
Exactly. They also highlight the importance of looking at network-specific metrics, like the percentage of the total supply that's being staked on proof-of-stake blockchains, which is really relevant for understanding the security and participation in those networks. And for DeFi, they emphasize the importance of TVL, total value locked, as a measure of how much capital is flowing into these decentralized protocols.
It's a whole other world of on-chain analysis.
It is. But the key takeaway here, and the Galaxy report really hammers this home, is that you absolutely have to understand the methodology behind these metrics. Don't just blindly trust a number without knowing how it was calculated and what it's actually measuring.
Right. Context is everything. And it's also important to remember that on-chain analysis has its limitations. Like, it can't capture everything that's happening in the crypto market. The Galaxy report mentions that it doesn't track trading on centralized exchanges, for example, or activity on layer 2 scaling solutions like the Lightning Network.
Right. It's not a perfect window into the entire ecosystem.
Now, that paper from RRSIF, it gives a really good overview of the different tools and platforms out there for diving into on-chain data. Everything from basic block explorers like Etherscan and blockchain.com, where you can view individual transactions and addresses, to more advanced analytical platforms like Dune Analytics, Flipside Crypto, Arkham Intelligence, Footprint Analytics, and Dappliker.
Yeah, there's a whole ecosystem of resources out there depending on what you're looking for.
And the paper also mentions research-focused platforms like Masari, Nansen, Chainalysis, Token Terminal, Into the Block, Glassnode, and Bubble Maps. It's quite a list. But they also point out some of the ongoing challenges in blockchain data analytics. Things like the cost and complexity of accessing the data, the sheer volume of data being generated, the difficulty in accurately identifying who owns which wallets, and the lack of interoperability between different blockchains. It's not all smooth sailing.
Definitely not. And speaking of challenges, the material from CryptoQuant highlights their work on trying to link those on-chain addresses to real-world entities like exchanges and mining pools.
Right, because knowing who's behind those transactions can add a whole other layer of understanding. And Nansen, they even offer features like smart money tracking, where you can follow the activity of wallets that have a history of successful trading. It's like having a front row seat to what the pros are doing.
It is. And our Stilio source, they highlight some of the key metrics that are available on Glassnode. Things like the exchange net position change, which tells you whether coins are flowing into or out of exchanges. The NVT ratio, which can be a potential valuation indicator. HODL waves, charts that show you the distribution of Bitcoin supply by age. Data on exchange balances, the mean hash rate as a measure of mining network activity, and the number of active addresses on the network.
So many different ways to slice and dice the data.
There really are. But I think the key takeaway from all of this, and all of our sources really emphasize this, is that on-chain data is incredibly powerful. It's like a window into the heart of these cryptocurrencies. But it's not a magic bullet. You need to approach it thoughtfully, understand the metrics, and be aware of the limitations. It's a tool, but it's only one tool in your arsenal.
Well said. So, as we wrap up this deep dive, the main point we want to leave you with is that on-chain analysis gives you this deeper, more fundamental understanding of what's actually driving these crypto markets. It allows you to move beyond just speculation and get a handle on the underlying activity, the real usage.
And the key is to remember that these different metrics and methodologies, they all provide different lenses through which to view a crypto asset. No single metric is going to tell you the whole story, so it's important to look at a range of data points and consider them in context.
And we really encourage you, our listener, to explore these concepts further. Check out some of those on-chain data platforms, play around with the metrics we've discussed, and start forming your own informed opinions about what those signals are telling you.
And here's a final thought to leave you with. Given this incredible transparency that on-chain data provides, how might this completely change how we understand financial markets, not just in crypto, but across the board? It's a pretty mind-blowing question to ponder.
It is. And on that note, we'll wrap things up. Thanks for joining us for this deep dive.
Until next time.